While you work hard for your money, unfortunately, Uncle Sam takes a bite out of each paycheck for income and other taxes. And for those of you in the middle class, that bite may seem a bit too big. Hello, everyone, and welcome back to the Finance Guardian channel. Now, when it comes to taxes, the Internal Revenue Service doesn't mess around. But if they're not messing around, then why do we keep hearing about wealthy people and wealthy companies not paying theirs? A number of high-profile figures walk into the IRS, including Jeff Bezos, Warren Buffett, Elon Musk, and Michael Bloomberg, but none of them appear to have paid federal income taxes in several years. So this got me thinking, what have these guys done differently to avoid paying taxes and not incurring any consequences from the IRS? Apparently, the tax code can be a bit complicated, and some of the wealthiest people in the world designed loopholes to keep their money out of Uncle Sam's pockets. So, watch this video to the end to find out how you can legally decrease your tax bill by stealing some of the tax loopholes the rich exploit. Hit that subscribe button and the bell beside it, and let's get started. Buy a whole life insurance. Life insurance policies are typically associated with the need to provide for dependents in the event of your death. However, wealthy people take advantage of a secret strategy by purchasing whole life insurance. Ultimately, it's an insurance policy and an investment account combined. According to Kirk Jewell, Certified Financial Planner, CFP, and President of Global Financial Services, you benefit from tax-deferred growth as the policy grows and when you use the funds for retirement. You can receive tax-free distributions if set up properly. This is a double benefit because the policy owner gets his tax break throughout his or her lifetime. And when they die, the benefit amount goes directly to the beneficiary he named, who receives it tax-free, minus any amount the policy owner spent on it. You can't just buy any life insurance policy and accept this tax treatment. Consult with a financial planner or an insurance agent who is qualified and experienced. You should also speak to an expert to determine whether whole life insurance is right for you. There are some experts who believe it is a bad investment, partly because of the high fees associated with it. Harvest tax losses. The U.S. tax law requires you to pay capital gains tax on profits you receive from taxable accounts. The worst part is that if you have gains that are short-term in nature, meaning you have held them for a year or less, you will be subject to ordinary income tax rates. According to IRS standards from the tax year of 2019, if you're in the top federal tax bracket, you'll owe 37% in federal tax alone on your short-term gains. To get around the short-term gains tax, shoot for harvesting your capital losses to offset those gains. If you own any investments that are trading at a loss, you can sell them, realize the losses, and use them to offset any capital gains you have. Even up to $3,000 of ordinary income can be written off if your losses exceed your gains. If you use a paper loss on a security to offset your gains, you can save thousands of dollars in taxes. Buy a yacht or a second home. It's probably not possible for most of us to afford to buy a second home on the beach or a boat. In any case, it's hard to believe that owning multiple residences would lower a person's tax bill. It generally works like this. If you have a home and itemize your deductions on your tax return, you will usually be able to deduct both the property tax and mortgage interest, though there is a cap of $10,000 for taxpayers to deduct property taxes. If you purchase a second home, you can deduct the taxes and the mortgage interest on that property as well. According to the IRS, yachts can qualify as homes if they include sleeping accommodations, a kitchen, and a toilet. This strategy probably isn't feasible for people who can't afford a second home, let alone an expensive one that floats. But even though you might only own one home, you should learn about tax breaks for homeowners. Sell real estate you inherit. If you inherit a piece of property, you can lower your capital gains taxes by taking advantage of quote-unquote step up in basis. In a normal scenario, if you buy a piece of land for $200,000 and then sell it for $450,000, you'll owe taxes on the $250,000 gained. However, if your parents bought the land for $200,000, then you inherit it, your new basis will be the fair market value of the property at the time of your inheritance. If you sell it right away, you won't need to pay any taxes on that $250,000 gain. A stepped-up basis basis is a process that occurs automatically to all property that passes through inheritance. Tax-wise, it's as if you're starting over by buying the property at the current price. Using the previous example, if you inherit the property when your parents die, you won't be liable for capital gains tax on the $250,000 increase in value when you sell the property using the step-up basis. However, make sure your parents don't leave the property to you before they die. In that case, they will be liable for heavy taxes during their lifetime, and any financial benefit to you will be significantly diminished. Make money from your investments, not your job. According to Account Lancer founder Eric J. Nisal, wealthy people can make their money work for them instead of having to work for it. Tax rates on earned income can reach up to 39.6%, which means people in the highest tax bracket only take home about 60% of their gross income. Nisal stressed, however, that anyone can invest in high-yielding dividend stocks. During the investment process, you collect dividends from the companies at regular intervals and later sell the appreciated stocks. Fortunately, long-term capital gains resulting from these sales are subject to only a 20% tax. You therefore pay less taxes on long-term capital gains than on the income you earn from slaving away at your salary job. Investing in real estate for rental properties is another possibility to earn money through investments. Be aware, though, it is not an easy process. You have to spend a substantial amount of money up front to acquire the property and fix it up if necessary before you can become a landlord and collect rent payments. It can also be risky picking lucrative properties in the right locations. It's crucial to find tenants who are responsible, pay on time, and won't damage your property. Providing urgent repairs and regular improvements can also be costly. Hire your kids. Turning a business venture into a family affair can result in more money into the business owner's pocket. For instance, hiring your kids may qualify you for tax benefits. The IRS reports that payments for services performed by a child under 18 in a trade or business owned by his or her parent are not subject to Social Security and Medicare taxes if the business is a sole proprietorship or partnership in which each partner is the child's parent. This can also reduce taxable profits. Trump, for example, employed an unknown consultant for hotel projects in Hawaii and Vancouver, British Columbia. As reported by the New York Times, the payment made to the consultant was identical to one Ivanka Trump received through her consulting business that year. Trump was able to write off these consulting fees as a business expense, thus reducing the amount of the final profit subject to taxes. You can pay lower taxes on your business income by transferring some of that income to your child as wages for services they perform. However, the work your child does must be quote-unquote legitimate and the salary must be reasonable. Deduct theft and casualty losses. Former IRS Special Agent and Attorney Julian Block said you might be able to deduct your losses if someone robs your house or if your basement floods. Obviously, you cannot deliberately lose or damage your property to get a tax deduction. The IRS allows deductions for household goods, homes, and other types of property damaged or lost as a result of burglaries and vandalism. This also applies to casualty losses, provided they are triggered by events that are unexpected, sudden, or unforeseeable, such as fires, floods, and hurricanes. The former IRS criminal investigator stated that, quote, "The IRS severely restricts the allowable amounts for theft and casualty losses and knows that complex rules cause many individuals to overstate their deductions, which is why IRS investigators ask probing questions about lost or damaged household items and other categories of personal property. Most homeowners cannot prove to the IRS that their lost property is worth the amount they claim since they don't keep adequate records. Is there anything you can do to increase your chances of deducting your losses? There is a free guide available from the IRS, publication 2194, Disaster Losses Kit for Individuals. It includes a workbook to help you keep track of all your household goods and personal property in every room of your house. In the unfortunate event that you think you will need to file an insurance claim or deduct losses on your income taxes due to theft or casualty, having a record of your belongings will be helpful. These and other tax strategies might be kept as secrets by the wealthy. However, when used correctly, these tax breaks and loopholes can reduce state and federal taxes for everyone. And that is all the time that we have today, folks. We hope you enjoyed this video, and if you did, please do remember to hit that like button. And if you're new around here, subscribe to our channel, and on your way out, please remember to click on that bell icon so you can remain updated about all of our future videos. You're welcome to the channel where you will learn the basics of personal finance in easy to understand language. We'll see you next time.